If someone handed you $100,000 today and said, build as much wealth as you can over the next 20 years, what would you do? Buy real estate or put it into the stock market? Real estate investors will tell you, buy property. Let the tenant pay the mortgage. Stock investors will tell you, buy index funds. Let compound interest do the work. And here's the strange part. Both can be right. Because the real question isn't which investment is better, it's what happens when we count everything. The leverage, the interest, the taxes, the repairs, the vacancies, the investment returns, and even the money you could have invested somewhere else. So today, Cherry is running the numbers, and we're going to find out where the missing dollar actually goes. The experiment. Let's create two fictional investors. We'll call them Maya and Daniel. They're both 30, they earn the same income, they live in the same city, and they both have $100,000 available to invest. Maya chooses real estate, Daniel chooses stocks. To keep this comparison fair, we're not going to assume either one is a genius. No perfectly timed market crashes, no miraculous property appreciation, no crypto moonshots. Just reasonable hypothetical assumptions. Maya uses part of her money as a down payment on a rental property. Daniel invests his money into a diversified index fund. And then we leave them alone for 20 years. Clue number 1. You're not only investing your money. Maya's biggest advantage appears immediately. It's called leverage. Suppose she buys a $400,000 property with a $100,000 down payment. She now controls a $400,000 asset, even though she only invested $100,000 of her own money up front. Daniel doesn't get that advantage. His $100,000 buys roughly $100,000 worth of investments. That's why real estate can look incredibly powerful. Imagine the property rises by 4% in 1 year. 4% of $400,000 is $16,000. Maya didn't invest $400,000 of her own cash. She invested $100,000. So that $16,000 increase represents a 16% gain on her original equity before considering financing and other costs. That's the magic of leverage. But there's a dark side. If the property falls 10%, that's a $40,000 drop. The bank doesn't say, no worries, we'll take 10% less mortgage this month. Maya still owes the debt. Leverage magnifies the good and the bad. Clue number 2. The rent check isn't profit. Now let's look at the part real estate advertisements love. Cash flow. Suppose Maya collects $2,500 in rent every month. Her mortgage payment is $1,800. Looks like she's making $700 a month. Except not really. Because the property also has property taxes, insurance, maintenance, repairs, potential vacancy, and eventually, very expensive things break. A roof doesn't care about Maya's monthly budget. Neither does a furnace. Neither does plumbing. And if the property sits empty for 2 months, Maya collects $0. But the mortgage still arrives. This is one of the biggest differences between gross cash flow and actual profit. The rent check is revenue. It isn't automatically wealth. And there's another expense that's almost always ignored. Maya's time. Finding tenants, answering messages, organizing repairs, checking the property, dealing with emergencies. If she does all of that herself, she's saving a management fee, but she's effectively running a small business. Clue number 3. The boring investment. Now meet Daniel. He puts his $100,000 into a diversified stock market index fund. No tenant calls, no broken water heater, no mortgage, no leaking roof. Just thousands of companies inside one investment. And here's the problem with Daniel's strategy. It's incredibly boring. There might be years when his portfolio goes up. There might be years when it falls 20%, 30%, or more. And unlike a rental property, Daniel can't look at his investment and physically touch it. But his costs are usually much easier to see. There's no property tax, no roof, no vacancy, no plumber. And if he wants to sell part of his portfolio, he can generally do that much more easily than selling a house. That's called liquidity, and it matters more than people think. Clue number 4. The money you didn't invest. But now we hit the most interesting part of this entire comparison. It's not just about what the investments earn, it's about what your money could have done somewhere else. Imagine Maya puts $100,000 into the property. Daniel invests his $100,000. At this point, Daniel has no leverage. Maya does. But now, suppose Maya has to spend another $500 a month on the property that Daniel doesn't have to spend. That's $6,000 a year. Over 20 years, that's potentially $120,000 of additional cash outflow before considering investment returns. And this is where simple comparisons break. You can't just compare house appreciation versus stock market returns. You have to compare the entire financial journey. Now, let's be fair to real estate. Suppose Maya's property appreciates steadily. She pays down her mortgage, the rent gradually increases, and after 20 years, she owns a property worth significantly more than she paid for it. That's potentially a very large amount of wealth. And she got there partly because she controlled a much larger asset using borrowed money. That's powerful. But here's the question: how much did she actually keep? Because the house didn't magically become valuable for free. She paid mortgage interest, property taxes, insurance, maintenance, major repairs, closing costs, and possibly selling costs. So the house's headline value isn't the same thing as Maya's net return. That's the number we actually care about. Now, Daniel's portfolio has its own problem. The stock market doesn't move in a straight line. There will be crashes. There will be scary headlines. There will be years when Daniel looks at his account and thinks, maybe I should sell. And that's where the real danger appears. Not necessarily the market, Daniel. Because a long-term investment strategy only works if he can actually stick with it. If he panics during a major decline, sells, and waits until everything feels safe again to buy back in, he can permanently damage the compounding machine. The spreadsheet assumes Daniel stays invested. Real humans? They're emotional, and emotions can be expensive. So which one wins after 20 years? Here's the uncomfortable answer. It depends. Change the property appreciation rate, the mortgage rate, the rent, vacancy, maintenance, taxes, or the stock market return, and the winner can change. But there's one variable people underestimate: how much you keep investing. Someone who invests $100,000 and then never adds another dollar is playing a very different game from someone who invests $100,000 and keeps contributing every month. Compounding isn't just about finding a magical investment. It's about time plus return plus contributions plus discipline. And that's something neither a house nor an index fund can do for you. So, should you buy real estate? Maybe. Real estate can make sense if you understand the local market, can comfortably handle the debt, have reserves for repairs and vacancies, and actually want to manage property. And leverage can dramatically increase your exposure to an appreciating asset, but it also increases your risk. Stocks can make sense if you value diversification, liquidity, simplicity, and long-term compounding. But you have to be able to tolerate market volatility without abandoning your strategy. And you don't necessarily have to choose one. For some people, the answer could be both: a home, a diversified investment portfolio, and a financial plan that doesn't depend on one asset doing everything. So, what did our investigation actually uncover? Real estate's hidden advantages: leverage. Stock's hidden advantage is liquidity and diversification. Real estate's hidden costs: interest, taxes, maintenance, vacancies, and your time. Stock's hidden cost: volatility and the temptation to panic. And the biggest missing piece? Opportunity cost. Because every dollar you put into one investment is a dollar you didn't put somewhere else. So don't ask, which one is guaranteed to make me richer? There isn't one. Ask, what does this investment really cost me? What risks am I taking? And what could this money be doing instead? That's how you stop investing based on stories and start investing based on math. And that's the missing dollar.